All right, good morning, everyone, and thank you for joining us this morning for Volpara's quarterly results investor webcast for Q2, covering the 3-month period that ended on the 30th of September 2020. So joining us on the line today, as you can see on screen, is Volpara's Group CEO, Dr. Ralph Highnam, Volpara Health CEO, Catherine Singson, and CFO, Craig Hadfield. Before I hand over to Ralph this morning, please be advised that all attendees are in a listen-only mode. Today's event will include a presentation followed by a Q&A. So to ask a question, you can either type it into the Q&A panel below with the Q&A button, or alternatively, you can press raise hand to speak with Ralph, Catherine, and Craig. Today's presentation is also being recorded. I'd now like to hand over to Dr. Ralph Highnam, Group CEO. Please go ahead, Ralph.
Cool. Thank you, Sam, and hello, and thank you for your time this morning to hear about our strong Q2 FY21, which ended 30th of September 2020. Volpara is a health technology company whose integrated breast care platform assists in delivery of personalised patient care and whose business model is predominantly based on software as a service, or SaaS. And we're on a mission to save families from cancer. We've much to cover today, including the traditional 4C cash numbers, which again show strong cash receipts despite coronavirus, strong sales growth to give an annual recurring revenue, or ARR, of just under $20 million, negligible churn, so we remain at around 27% of the US market. We've also included unaudited HY21 revenue numbers, which show a 38% rise compared to last year. We're going to talk a little about the FDA and their breast density reporting legislation, the status of that. And then we're going to talk a little bit around strategy and give you an update on where we are since we launched a kind of a new strategy around driving demand from women in the middle of this year. And you'll have seen this week the launch of Project FUM in particular. Now, before we jump into the main commentary, I just want to acknowledge the whole company for their contributions towards us winning the Supreme Award for Wellington companies last week. There are multiple world-class companies in Wellington, including the likes of Xero and TradeBee, and to be judged the leader of that group is an outstanding testament to what we've achieved through world-class staff, world-class products, but also world-class investment. So thank you all for your conviction, faith, and trust in us over the years. Okay, let's start then with the 4C cash metrics, which were posted up earlier today onto the ASX platform. We're delighted to say that during Q2, we had cash receipts from customers of $4.7 million. That's just slightly below what we recorded in Q2 last year, but in that Q2 last year, we were still doing lots of capital sales rather than SaaS sales. We would actually have been well over Q2 from last year, despite coronavirus, if we'd not moved from that capital sales model to the SaaS one. Looking more deeply into those cash receipts, as per the 4C we put out, shows that the receipts from SaaS customers actually rose by more than 16% year on year. And over the half year, our cash receipts have risen by 33% or so. Those receipts demonstrate again our resilience as a company, our resilience in terms of the business model, and the resilience of the industry. Yeah, you can pause breast cancer screening, but you cannot stop it, because otherwise you do end up with many more advanced stage breast cancers, which no one in the world wants to see. During the quarter, we had net operating cash flow of New Zealand 3.5 million, ahead of internal expectations and well within our budgets. And pleasingly then, the third quarter of reducing cash burn, showing continuing tight control of costs alongside continuing to achieve strong sales growth. Cash on hand at the end of Q2 was 64.3 million, which is obviously a very healthy position to be, and the result of the capital raise in April, which aimed to strengthen the balance book, but also give us the ammunition for potential further M&A should the right opportunity arise at the right price at the right time. And we'll touch on that again shortly. Turning now to the SaaS, or recurring revenue metrics, they remind you all that all new quotes now for any Volpara products are now all SaaS, although there are a few still historical capital deals coming over the line. We disclosed many of these metrics early in October in one of our recent virtual investor presentations. So during Q2, despite coronavirus, we booked a significant jump in ARR, annual recurring revenue, to reach $19.9 million, which made Q2 our strongest Q2 ever for new sales, which I think is a remarkable result given the circumstances and given the changes we made to the commercial team over that period. I'd like to thank all our staff remaining very, very focused over this period and getting these deals over the line and delivering such a stellar result. I'm happy to also report that net churn of ARR remains negligible. However, as previously reported, we have seen the percentage of women that we cover drop very slightly over Q2 due to cost pressures from coronavirus at some of the bigger sites with the MRS legacy software. Those sites, to remind you, were done on capital sales. So if they don't pay the software maintenance, the software keeps on working. So yeah, we find some of those sites appear to be holding off renewing their service and maintenance contracts, or they're looking to use their kind of more generic and far less featured electronic patient record system rather than the expert breast-specific ones from Volpara. Importantly, those sites where we're seeing that cost stress tend to have very low ARPU associated with them. So we're still very happy then to report end Q2, we help over 10 million women a year get better breast cancer screening, and that represents around that 27% mark of US women using at least one of our product. But again, it's clearly a big priority of ours now to get those old legacy capital customers onto new SaaS contracts. We've had great success now moving MRS 6 customers off that and onto SaaS ones, and now we're starting to really focus onto the newer MRS 7 customers. As we do that, we do see a big jump up in recurring revenue at each of those sites. Clearly, though, install base continues to be vital over this next period. With no trade shows, now is the time for us to focus on the pipeline we have and mining the install base for upselling opportunities. That opportunity really is reflecting the ARPU. We've had a good increase in ARPU across the entire install base up to $1.16 now. But the new contracts we're signing range from $1.75 up to $4.30, depending on size and structure. And we continue to have a very strong pipeline with some excellent deals in there. You're ranging up to even up to $8 or so per woman. Notable deals in Q2 included one of our biggest and oldest customers based in North Carolina, a very happy Volpara enterprise user, which is our enterprise-wide quality assurance tool, moving to a much broader package, including the MRS Aspen software, and they've renewed for a further 5 years as part of that new deal, and that total deal will be worth over $1.6 million US to us, one of our biggest deals to date. But always very gratifying to see happy customers coming back to renew and expand what they receive from us. Also very happy then to receive deals this quarter from Fuji and GE. It does feel, at the start when you launch a product, I think we all know you want to avoid OEMs, but once those products become very clear winners, you find that OEMs are good routes to help you scale. So it's good to see Fuji and GE both producing new deals during Q2. We did do a press release with Fuji on Huntsman Clinic in Utah, which is a very major site with a very well-known radiologist that came out a couple of weeks ago. In Australia, Sonic in Queensland and iMed's Dr. Jones in Adelaide all signed up to new and extended contracts, and we always like to see these contracts coming through in Australia and New Zealand because it's great to see our software being used to help local women. In short then, Q2 was strong despite coronavirus. Our sales pipeline remains strong despite coronavirus. Nonetheless, with no in-person trade shows and with coronavirus re-emerging strongly across the world, some uncertainty does remain for the rest of this financial year, and we very much need to keep on our toes and not let our focus drift over this period. On to then some of the half-year results that we dropped in. So at the end of November, we'll do the full half-year report. The numbers we've put in the 4CR are unaudited numbers. Our financial year started on 1st of April, so our half-year results then, which we've put in there, show half-year revenues of $9.5 million. That's up some 38% compared to last year. Pleasingly, again, most of that rise is due to SaaS revenues, those recurring revenues, which are so critical for a company like us. And they are up more than 70% year on year, with the one-off capital revenues correspondingly decreasing. So let's now talk about some of the big subjects which we've been waiting for. The FDA would be expected the FDA to announce the final wording and timing around their new breast density legislation by end October. But it's obviously a busy and chaotic time in the US, and we're seeing and hearing no signs it's going to come out this week, albeit that the FDA could yet surprise us. The latest information that we've heard from the main patient advocacy group, Dense Breast Info in the US, is that they believe the FDA will be updating us on the planned legislation in the US fall. Now, there's no firm definition on what the US fall is, but I believe that's sometime between now and the equinox, which is in mid-December. We'll update you on that as soon as we hear more, but obviously there's a very big event next week in the US, which I think is where most attention in the US lies currently. In any case, we're not waiting for the FDA, we're not waiting for legislation. We've got a big install base. We are out there now telling women this important breast health information on a daily basis now to millions of women about breast density. And you'll have seen from the Project Farm announcement we put out earlier this week, which we'll talk to a bit later. We're really going to the next step now, moving beyond just the basic information to really working out the best ways of communicating this information to women, so they don't just look at it and kind of nod their head. They actually look at it, read it, understand it, and then act on it. So we're very much not waiting for the FDA. We're cracking on with our important mission to save families from cancer. Now, the other thing that we're waiting on is various big public screening programs to go live, because they will announce that when it goes live. The deal was in December. That was signed, at least with one state. It's now been delayed, though, due to coronavirus. Coronavirus increasingly appears under control in that state, so we're hopeful that will go live sooner rather than later. And again, we'll let you know as soon as that happens. Now, in terms of strategy, in July, we embarked on a bold new strategy to ensure the company was tuned and adapted for the new coronavirus world, where there are no trade shows and few on-site visits. We also committed to a number of strategies to become more scalable. In the short time between then and now, Catherine and her team have done a remarkable job pivoting the sales team to digital marketing for sales to breast imaging centers, whilst laying out a strategy to get women demanding Volpara quality breast care. You'll see the first shots in that direction this week, as we announced a new partnership with long-term Volpara user Henry Mayo over in California to develop image-enhanced reporting to convey the meaning of breast composition or breast density to women. This is critical to women actually understanding what breast density is, but I also want to just stress how we're in quite a unique place to actually deliver this enhancement or enhanced reports. We're one of the few companies in the world that have access to the data, have access to the images, and actually have the ability to insert those images into patient letters. But also, as many of you know, we do have competitors in the breast density space. They give out an ABCD, which is kind of all well and good, but breast density is starting to move far beyond that. And the future of breast density is change over time and tracking things over time. And as you'll see in Project Farm and some of the information coming out in those letters now, our technology, our kind of unique technology around scoring women volumetrically, which means we can score breast density locally at any point in the breast, is critical to how you display those images, and will really help us stand out versus the competition over this next period. I'm also then delighted also to report, we talked about 1st of October, formally releasing our new platform software at the AGM. I think we talked about that. That is now out, and which is a great result from our engineering team here in Wellington and Seattle. Importantly, a lot of that is built on an IoT-like platform, which makes it much easier to deploy, monitor, and update, all of which will help us become much more scalable. Next week, you're going to see a press release around a partnership with Sydney-based Detected X, a world leader in remote radiology training. We've already noted this in an ASX release, but you'll see a press release on that next week. And again, the model there is using their software to help us get to a more scalable business model, with much better remote training of radiologists in what we do. So look, as you can tell, we're very pleased with how things are coming together and convinced the changes we did over the course of Q2 are paying major dividends, and they're going to keep paying major dividends over the next 6 months as well. I will just note then, M&A remains a key part of our strategy. There are multiple opportunities starting to present themselves as companies globally struggle for capital or seek access to our installed base. But the line that we've been towing all along, we're going to be very disciplined with the money that we have in the bank, and it has to be the right deal at the right time at the right price. So with that, I'd like to open up the floor to questions to myself, Craig, or Catherine.
Thank you, Ralph. So now we've got about 15 minutes for questions. So just a reminder that if you wish to ask a question, you can enter it into the Q&A panel at the bottom of your screen, or alternatively, you can press your raise hand button to speak with Ralph, Catherine, or Craig. So we've got a question coming in from Will McDermott. So you'll just need to unmute your device and you can go ahead.
I think I'm unmuted. Hi guys, thanks for answering questions. Can you just talk a little bit? I mean, you've obviously developed quite a few products and have quite a number in your stable now. Enterprise is always a very key feature of your growth outlook. Obviously, Enterprise Live, MRS is a part of your offering. Density clearly is a very big part of what you guys do, if not the leader. Can you just talk a little bit around what is the product leader today? What really wins you contracts? And I guess provide some examples of how that's expanded for some customers.
Yep, that's a great question, Will, and I will just give you all a heads up that we are, as part of Catherine's new sweep through the company, we are in the process of renaming a few of these things to make them more obvious about what they are. I think that's going to be a great move. Yes, over the last few years, Enterprise has really been one of the lead products for us. But I think now we've seen that with the launch of the platform, the integrated platform, we're seeing new dynamics come into play. And when we brought MRS last year, principally we brought it to get access to the data. So to merge the patient data from the images, and we are doing that, and we're getting the value from that now day in and day out, which is a great place to be. But also now we've started to realize how important the MRS software is in terms of really being the platform for a lot of breast imaging centers, the kind of key infrastructure for a lot of breast imaging centers to then hook AI into all our AI tools. So going forward, Enterprise is still key, and we've had lots of very good feedbacks and renewals of that over the last wee while, which is great to see. But I think fair to say we're seeing increased interest now in the whole platform. People recognize the power of a fully integrated platform where breast density flows into the patient tracking software, which then generates a breast cancer risk score, which then flows back to a scorecard for the radiologist to see and act on. So we are seeing increased interest in the whole platform, and I think fair to say, and I'm sure Catherine is going to say this as well, Aspen, Risk, Enterprise really are key ones. Buzzing around the edge, Live is coming back into its own now as we start to get strong usage, but really that's that core platform where we're seeing a huge amount of interest. Catherine, do you want to add anything to that?
No, the only thing I would add, Ralph, is that we've had great success with team selling as well in the field. So with the acquisition of MRS, having the existing sales force from MRS working closely with our Volpara team has been a great opportunity for us, and it's been great to watch them work together.
Okay, thanks. I guess as you're moving into MRS 7 and that transition across to the SaaS-based model now, presumably the bulk of the MRS customers were on that. So hopefully you start seeing a more accelerated pickup in ARPU. And I guess how distinct are the features from MRS 7 versus what you're selling them up to? I'm just trying to think about how that transition across to a more recurring based fee model will work for customers and the value proposition.
We've been very happy with the MRS6 transition. There were hundreds of users on that probably 6-9 months ago, and we're getting much higher recurring revenues by moving them up to Aspen. The jump from MRS6 to Aspen is a big jump. MRS7 to Aspen is less of a jump, but what we've managed to do with Volpara, with the Volpara products, is really put together a very compelling package now for MRS7 users to move up to. So, for example, we have sites moving up to Aspen, and with it, they get all the hooks into Volpara Enterprise. So Volpara Enterprise is proving now to save massive amounts of times in FDA audits, for example. But it's greatly helped now by having certain information come across from Aspen and go up into it. So there's all these kind of integrations now between the individual products, which make the overall product suite much more compelling and present a much more compelling reason why you want to upgrade to Aspen. As you say though, most of the MRS data set is actually on MRS7 today, and I think mentally we have some moving across, but Craig's doing a lot of great work, really starting to build up a whole project plan around moving over, because as we move them over, we've obviously got to keep business as usual moving. We have lots of new customers out there buying our software that we need to get installed, trained, and happy. But in the background, then we need to get all these other ones moving along as well. So we're doing some very careful project planning around that. Craig, anything you want to add?
The only thing I'll add, Will, is anecdotally what we're seeing, mainly with the MRS6, but also with some of the MRS7, is that the ARR increase we're seeing with the upgrades is in the region of 200 to 300%. Some of that is just pure upgrade from MRS6 to Aspen Breast, but like Ralph mentioned, often there's upsell as well of other products, risk and or density and or enterprise. So the MRS7 to Aspen Breast upgrade opportunity, in my mind at this point, probably represents one of the biggest opportunities in front of us for the next 18 months. Well, 18 to 24 months, I think, is sort of the horizon to sort of convert those over. But there is a reasonable jump in ARR that we're seeing on those.
Okay, great, thanks. And I'll just one final one. Might see if I can wrap a couple of questions into it. But just in terms of capital sales, I understand that you're moving across to SaaS, but should we expect much in capital sales in the second half? And then also, good to see costs come down a little bit, I guess, at least reading through from the cash outflows. Can we take that as a bit of a run rate for the rest of the year?
Yeah. Shall I touch on those, Rolf? I'm happy to.
All yours, Craig.
So on the cost side of things, we have been saying for probably the last 2 quarters that we will see costs drop off in Q2. That's definitely happened. And for the remainder of the year, we can expect costs to be somewhere in that range. There's not going to be a hell of a lot of increase or decrease from where we are currently in terms of run rate. Can you just repeat the first part of your question again, Will?
Yeah, sorry. Just in terms of capital sales, I understand that, just in the second half, should we expect any at all?
So one of the things to understand is, although most of our quotes all of our quotes going out now are really on a SaaS model, we do have some customers on MRS6 or MRS7 that won't or cannot upgrade to Aspen Breast for in any given reason. Those ones who are on 6 or 7, they are going to continue to purchase various upgraded pieces, more site licenses, more user licenses, etc., on their old capital model. So we will still see a trickle of capital come through, and I think I stand to be corrected, but we were around about the $500,000 to $600,000 mark for H1 for capital sales. I'd expect it to probably be somewhere in the same range for H2. They're going to continue at a slow pace for the foreseeable future.
Okay, appreciate it. Thanks very much.
Cool.
Thanks, Will. The next question is, what was the churn rate compared to new or ongoing customers? And do you have qualitative data as to why there is, or as to the churn?
Yeah, I'll answer that one, Sam. So yeah, we've had very low ARR churn, which has been great to see. We have talked about. We launched SaaS 4 years ago, and I think fair to say we've seen very little churn over that time. When we do see churn, though, we do deep dive into it, and it's always for a variety of reasons. I mean, for example, someone buys the software and then the hospital IT, for whatever reason, doesn't install it or can't install it for a year. After a year, they look at it and go, well, our IT hasn't been able to install it, even though it's quite an easy installation. That's kind of one example. Or someone buys it and then a month later they leave, so the champion has left. That's been one or two sites we've had that. Yeah, and right the way through to, I mean, if a hospital recently laid off 2,000 people because of coronavirus, obviously they're under a lot of pressure. And if they brought the software on a capital model, then they ain't, if they know they can stop paying us a service and maintenance agreement, but still use the software, that is one route for them to cut costs. And certainly we've had a couple of those as well. So we do analyze each and every churn. We're fortunate it's not been a lot, but we do analyze it all just to make sure there's nothing we're doing wrong in terms of overselling, in terms of installing or training badly, right the way through. I think fair to say as well, one of the things that we're excited about with the IoT platform that we're pushing, or IoT-like platform that we're pushing out now, is it allows us even better monitoring of sites and monitoring of usage, so we can get ahead of the game, and if a site is in trouble, we can get in much earlier and deal with that. And Mark Morris over in Seattle has been outstanding now with getting a customer success team really up a level and really monitoring all 600 sites or 600 plus customers that we've got, 2,000 sites, and really trying to pick up early signs so we can get in there and act early.
Thank you. For the second half of FY21, do you expect this will be the strongest selling period of the year?
Yeah, that's a great question. I mean, Craig and I have been talking about this, and I'll let Catherine talk a little bit about the pipeline in a minute. History tells us that traditionally Q3 and Q4, which we're in now, are our strongest ones. And we certainly believe going through the pipeline with the capabilities there to actually achieve that. However, with coronavirus spike in the US elections, there is a great deal of uncertainty out there. So we are quietly confident, I think, around Q3, Q4, but we're going to have to just see how things play out in the US, in particular, given that's our biggest market. Catherine, do you want to comment on that?
Well, I might just add in that, as you may recall, we've recently reorged the sales group, and under the new leadership of Deb Saunders, things have been going very well, and each individual salesperson's dedication to the market has been very, very impressive. So we're really, nose to the grindstone. We want to have a great half two. We're working hard. We've got a number of different deals in the pipeline from small to large, and so we're not going to let our foot off the gas, that's for sure.
Thank you, Ralph and Catherine. So the next question is a question for Catherine. Can you tell us more about Henry Mayo, who they are, how many women do they see, how they're going to start this process of increasing their comms with their client base, and what Volpara products do they use?
Mm-hmm. Thank you. Yeah, it's actually a real privilege to talk about Henry Mayo. I don't have the exact numbers of how many women they see, but it is a boutique breast center with obviously a very famous name here in the US. And like many sites, we have a great champion with Mari, who is the clinical manager. And she's really, truly an innovator and a visionary in terms of progressive patient-first organization. And so, you know, we were blessed to have the amazing, you know, connection between the mammography record systems that we'd acquired, plus our deep knowledge of imagery, and to be able to transform something as simple as a patient letter, right? Patient letters have been going out for decades, but they have not evolved. And one thing I've learned very quickly in my short tenure here is that many of our clients want us to help message directly to women. You know, it's a confusing and sometimes overwhelming concept to understand breast composition and breast density, and obviously we're experts in it. And so that we can actually bring our technology forward to enhance the lay letter and to bring that information right to women is exciting. And so we now have a product marketing group that's working directly with Mari, and will continue to hone and refine that, that vision to actually bring thumbnail imagery into the letter directly to women and start to carefully and effectively communicate more than just words about your breast composition. So very exciting time for us. She's an extraordinary partner, and I feel very fortunate to have had her commit to be our initial prototype partner. And we have several others that are coming up to speed soon too.
And I'll just add to that, Henry Mayo has been a long-term Volpara user, I think 2012 or 2013. They started on density, went up to enterprise, and I think now they're moving to, you know, to the whole platform and risk and the new patient letters.
Thank you, Catherine and Ralph. So we do have time for a couple more questions. So just a reminder that if you do wish to ask a question, you can enter it into the Q&A panel or press the raise hand button. The next question is a two-part question, so I'll ask both parts separately. The first is, can you give more detail on your sales team productivity metrics? How do you measure it, and how is it tracking now that Catherine is on board?
That's a good question, Sam. Certainly, obviously, you know, there's key metrics that we do look at, such as the amount of ARR people sell each year, but also you know, we don't just look at the sales team, we look at the whole company, and we do look at things like customer acquisition cost, and we're still trying to work out the best ways really of measuring that, so we can start to track productivity moving upwards. And you know, customer acquisition costs kind of moving downwards. And it's, yeah, we are doing a huge amount of work behind the scenes. Craig's team is in you know, bringing forward better software to analyze all the data to get better numbers to help us drive things in certain ways. Craig, do you want to note anything around some of those metrics, or Catherine?
Well, I might just add in that, you know, obviously we have targets and quotas for each individual, and we work together as a team. But probably the largest change that we've made, not only in the restructure of the sales group, is also standing up a very formal marketing group, both a product marketing group and a marketing communications group. And the primary of our marketing communications is based here in the United States and working really hip to hip with the sales organization to provide them new leads and new mechanisms into our market. And so you can imagine we had a massive change in our organization with the onset of COVID. So we have no longer the traditional trade shows, et cetera. So we've really swung towards digital and are trying some new things, which are wonderfully measurable in the world of digital. So it's actually been a great time for us to unleash and try new mechanisms with which to feed our pipeline. Craig, do you want to add?
Yeah, the only thing I'll add is, you know, over the past few years, we've sort of monitored customer acquisition costs to the extent that we can. And, you know, with some of the recent changes we've made, you know, there will be a somewhat large increase in the efficiency of our customer acquisition costs. So, you know, we continue to track that, and yeah, I think it's definitely improving over time, as in how we evolve the sales organization under Catherine's leadership.
So Sam, I think the answer is yes, we have metrics, and they're all going in the right direction, but yeah, we're not going to make them too public.
Thank you. So the second part of this question is, why has your US share of screening not moved in 12 months?
Not sure about 12 months, but certainly over the last quarter, and I can't remember where we were in Q1. So yeah, we obviously have a very big install base, which is great, and we've been getting new sales. But some of those, as we talked about a bit earlier, some of those MRS legacy customers with the big, they buy it could be a site with 60, 70,000 women. For example, that kind of site could be paying us, as low as 10 to 20 cents per woman. So it's a very, very low ARPU in terms of the service and maintenance contracts. If that kind of site decides not to renew the service and maintenance agreement for whatever reason, including COVID cost pressures, for example, then obviously that 67, or that, we don't count that 60, 70,000 women. So that kind of comes out of our 27% number, but then the new sales push it back up again. So there's kind of been moving around like that, and obviously it's our job now to get all those old legacy ones, as we talked about a bit earlier, over to SaaS. So it's much harder for people to move off them, and then that number will start tracking up again in the right direction.
Thank you. And there are no further questions at this time. So I'd now like to hand back to Ralph, who will close today's session.
Cool. Thanks, Sam. Thanks for your time today. As you can tell, we're a remarkably resilient business, helping millions of women each year, and moving into all kinds of interesting new areas this quarter and onwards with Project Fun, which we are all genuinely excited about where it's going to lead us. Thank you for your continued interest in our mission to save families from cancer. Thank you.